The balance of payments records transactions conducted between residents of a country and the rest of the world, and it covers three main accounts. The financial account, which records international monetary flows related to investment in businesses, stocks and bonds. You have the capital account, which records international capital flows from the sale or acquisition of fixed assets like land or production facilities, but it's the current account that we're really interested in here. And this in itself is made up of four different flows. We have trading goods, which are payments for exports and imports of physical goods, like cars or computers. We have trading services, which are payments for export and import of non-physical services. So these are more intangible things, like insurance or business consultancy. We have primary income, which includes dividends earned on share ownership, or remittance incomes, which are incomes that are earned in one country but sent back overseas. And then secondary income, which includes gifted income with nothing flowing back in return, like international aid. As the current account records all of these financial flows, at any point in time it could be in deficit or in surplus. So a current account deficit means that outflows on the current account are greater than inflows from abroad. And as exports and imports are by far the biggest part of that current account, it generally means that the value of imports are greater than the value of exports. A current account surplus would mean the value of exports are greater than the value of imports. Inflows on the current account are greater than outflows. And it's really common to confuse these current account surpluses and deficits with budget surplus and deficits, as we're using the same terms to describe them. But with the budget balance, that's about the balance between government spending and taxation, and that's totally different to these financial flows into and out of a country. The current account balance will be influenced by a wide range of different factors, some of them pushing it towards deficit, while others might help to bring about a surplus. So an increase in productivity would make it easier to sell exports because it would improve international competitiveness, and that would make a surplus more likely. However, higher rates of inflation would have the opposite effect. Rising prices at home will make it more difficult to compete on international markets, selling fewer exports, making a deficit more likely. Depreciation in the exchange rate makes it cheaper for other countries to buy our exports, and so increasing the demand for them, while at the same time reducing demand for imports by making them more expensive. The combined effect of that makes a surplus more likely. It's just worth being aware that that does depend on the price elasticity of demand for exports and imports, and this can be seen in the J-curve effect, which we'll look at in a different video. If people in other countries have more money, then that would cause more demand for exports and so make a current account surplus more likely.